Okay, let's just think about this for a second. Imagine a global financial system, right? One that operates entirely without central banks or governments. Sounds revolutionary, doesn't it? Or maybe just a little bit chaotic. Yet, this is pretty much the world cryptocurrency has ushered in. It's this digital frontier, and the scale is just, well, staggering. We're talking a market cap estimated at $2.76 trillion as of April 2025.
And over 25,000 different digital currencies out there. It's massive.
Welcome to the deep dive. This is where we take your stack of sources, could be articles, research papers, even your own notes, and we really try to extract the most important nuggets of knowledge, the key insights. Today, we're diving deep into that fascinating, complex, and yeah, often turbulent world of cryptocurrency.
Right. And our mission really is to cut through all the hype,
Right.
and the jargon. We want to give you a clear understanding of the basic technology, how it's evolving so fast, the economics behind it, and the different global perspectives. We'll even look specifically at India's unique journey with crypto. We want to explore not just what it is, but really why it matters and how it's shaping our financial future, the good and the bad.
Okay, so let's start right at the beginning.
Mhm.
How do we even define a cryptocurrency? At its core, what is it? Because it feels fundamentally different from, the money we use every day.
It really is. At its heart, a cryptocurrency is a digital asset. It's designed to work through a huge computer network, completely independent of any central authority, no government, no traditional bank. Think of it like digital cash, maybe, where your ownership is recorded on this public digital ledger. And that ledger, for most cryptos, is what we call a blockchain.
The blockchain. Yeah, everyone's heard that term, but what makes it so pivotal? Why is it so important here?
The blockchain is absolutely key. It solves a really fundamental problem. How do you trust a digital record? Something that could, in theory, be easily copied or changed. Well, the blockchain is this continuously growing list of records. They call them blocks, and they're all secured with cryptography.
Okay.
Each new block is cryptographically linked to the one before it. That creates a chain, right? And that chain structure makes it inherently resistant to being modified later. It's an open, distributed ledger. Everyone on the network has a copy. It's managed peer-to-peer, and it achieves something called decentralized consensus.
Decentralized consensus. So everyone agrees on what's true without a central boss telling them.
Exactly. No single controller needed.
But how?
Yeah.
Without that central bank, how does that agreement on transactions actually happen across such a vast, distributed network? That sounds like a huge challenge.
It is. And that's where these clever consensus mechanisms come into play. We mostly see two common ones. First, there's proof of work, or POW. Bitcoin uses this famously.
Bitcoin.
Here, you have miners using these really powerful specialized computers. They validate transactions by solving complex cryptographic puzzles. It's kind of like a digital lottery. The first one to find the solution gets to add the next block to the chain, and they earn some newly minted crypto as a reward. All that intense computing effort is what secures the network. It makes it incredibly difficult and expensive to cheat the system.
Okay, so that's proof of work. What about the other main one? Because I know Ethereum made that big shift recently.
Right, exactly. That's proof of stake, or POS. Instead of raw computing power, validators are chosen based on how much of the cryptocurrency they stake, basically how much they lock up as collateral.
So they have skin in the game.
Precisely. Ethereum's big merge in September 2022 was exactly that move, shifting from POW to POS. And the big driver was energy consumption. They aimed to reduce it by something like 99.9%. So here, the security comes from economic incentives, from that stake, not just burning electricity.
It's amazing how quickly this all took hold. But, the idea of digital cash itself, it isn't brand new, is it?
Not at all.
We saw concepts bubbling up for decades, like David Chaum's eCash way back in the 80s,
Yeah.
even papers from the NSA in 96, and things like B-Money and BitGold in 98. The ideas were brewing. But then came Bitcoin, created by the still mysterious Satoshi Nakamoto in January 2009. That really brought it to life. And that first block, the Genesis block, it even contained a newspaper headline, right? About a bank bailout.
Yeah, the Times headline. Many saw it as a comment, a subtle dig at the traditional financial system's instability right after the 2008 crisis, a defiant start.
Definitely.
And that spark just ignited an explosion. Since Bitcoin launched, the market has expanded at, well, an astonishing rate. You mentioned the numbers earlier. As of June 2023, over 25,000 cryptocurrencies. and more than 40 of them had a market cap over $1 billion.
Wow.
So this isn't just about digital money anymore. Depending on where you are, these assets are being classified as commodities or securities or maybe a whole new asset class entirely.
Hmm.
It reflects how complex and, frankly, how integrated they're becoming.
So Bitcoin was the pioneer, the proof of concept. But it's just one piece of this huge expanding universe now.
Yeah.
Everything that isn't Bitcoin often gets lumped together as altcoins.
Right. Altcoins. Or sometimes, yeah, less kindly, you hear shitcoins.
Oh, right.
And these altcoins, they often try to do things differently. Take Litecoin, for example. It aimed for faster transactions, confirming a block every 2.5 minutes versus Bitcoin's 10 minutes. But Ethereum, that was a bigger leap. It introduced smart contract functionality.
Smart contracts. Okay, unpack that a bit.
Think of a smart contract not just as code, but like a digital vending machine for agreements. You define the conditions in code, the blockchain verifies if they're met, and boom, the outcome happens automatically. No need for a human middleman.
Okay, interesting analogy.
And this allows for decentralized applications, or dApps, to run directly on the blockchain. That made Ethereum hugely popular. It became the most used blockchain by 2020. It's more of a platform, really, than just a currency.
That is a huge distinction. Platform versus currency.
Mm.
Okay. And beyond those, there are two other categories that always seem to pop up in discussion. Stablecoins and meme coins.
Yeah, good ones to cover. Stablecoins are designed to, well, maintain a stable value. Usually, they achieve this by being pegged to something like the US dollar. The whole idea is to give people the benefits of crypto speed, low fees without the wild price swings.
Sounds sensible.
But they're not foolproof. We
Mhm.
saw that very dramatically with the Taro ST crash back in May 2022. UST was supposed to be $1, always.
I remember that.
It collapsed, fell to like 26 cents, wiped out nearly $40 billion in value. That event really shook confidence. It showed that the stability mechanisms aren't always reliable and raised huge questions about how they're backed and regulated.
Yeah, a very stark reminder of the risks involved. Okay, and then at the complete other end of the spectrum, meme coins.
Meme coins,
Yeah.
right. These are cryptos that literally started as internet jokes or memes. Dogecoin is the classic example, with the Shiba Inu dog face.
The dope.
Exactly. They're famous for extreme volatility. Dogecoin went from, 73 cents down to 13 cents by mid-2024. Just
Yeah.
massive swings.
Incredible.
And you have to be really careful here. Scams are, let's just say, prolific in the meme coin space.
Mhm.
It's often driven by hype and social media trends rather than any underlying value.
So a dog's face can be worth billions one day and then almost nothing the next. It definitely makes you think about market psychology, doesn't it?
It absolutely does. And whether they're serious projects or, jokes,
Yeah.
all these digital assets need an engine to run. So let me pull back the curtain a bit more on how they're actually created and maintained, especially those energy-hungry proof-of-work ones.
Right, back to mining. So this is the process of validating transactions on the blockchain.
Yeah.
Miners use that specialized hardware. We're talking FPGAs, ASICs, basically custom-built super-fast computers to generate just tons and tons of these cryptographic hashes, these digital fingerprints, until one matches the target. That secures the ledger, validates the transactions. And for doing that work, they get rewarded with new crypto.
Mm.
It's been this constant technological arms race ever since Bitcoin launched in 2009, building faster and faster hardware.
And that arms race has a really significant side effect, the environmental cost. Proof-of-work mining uses absolutely enormous amounts of electricity. Just Bitcoin alone, in 2021, its estimated energy consumption was similar to the entire country of Greece. That's about 65.4 million tons of CO2 equivalent.
Wow, like Greece, that's a lot.
It's huge. And this isn't just an environmental issue. It raises fundamental questions about, can crypto scale responsibly? What's its future in a world focused on carbon reduction? Plus, critics point to a large electronic waste problem because this specialized mining hardware becomes obsolete very quickly as newer, faster chips come out.
That energy usage actually triggered massive global shifts, didn't it? China cracked down hard on mining in 2021, mainly due to power concerns.
They did. A huge chunk of the global mining power was forced to relocate almost overnight.
And the U.S. became a major beneficiary, right, along with other places.
Yeah, the U.S. emerged as a top global leader in mining hash rate. Places with cheap electricity, often cooler climates to help with cooling the hardware, and crucially, friendly regulations. Think parts of Canada, Texas, they became the new hotspots. Shows how quickly the industry can adapt.
Definitely.
And this brings us back to proof of stake. In stark contrast to POW, POS blockchains have dramatically lower energy footprints. We're talking, maybe the equivalent of a housing estate. compared to a medium-sized country for POW.
That's a massive difference.
It is. Cryptos like Cardano, Polkadot, Solana, they're often highlighted for being much more energy efficient using POS. So the big question becomes, will these environmental pressures push more and more cryptocurrencies towards proof of stake? Or will the perceived decentralization benefits of proof of work keep it dominant for some? It's a major ongoing debate.
It is. So, okay, on one side, massive energy use, e-waste. But on the other, there are clearly strong incentives for people to actually maintain these networks. What keeps that engine running? What motivates the miners or validators?
Well, in proof of work, the big one is the block reward. When miners successfully validate a block of transactions, they get rewarded with newly created units of the cryptocurrency. This increases the overall supply, and it's crucial because it pays them for dedicating all that computing power, right? It makes verifying transactions a costly business, which is actually what makes the network secure. Hard to attack if it costs a fortune.
Okay, block rewards. What else?
Then you have transaction fees, sometimes called gas fees, especially on networks like Ethereum. Users pay these fees to get their transactions included in a block, especially if the network is busy and they want it processed faster. The fee amount can vary a lot depending on the crypto. Ethereum's fees are based on how computationally complex the transaction is. Bitcoin's depend more on the transaction's data size. And interestingly, some newer cryptos, like Nano, actually have no transaction fees at all. They use a different system to prioritize things.
Fascinating. Okay, so we have these incentives, but we also talked about volatility. And roller coaster barely covers it sometimes, does it? Are there specific things within crypto markets that drive these huge swings?
You're right, roller coaster is an understatement sometimes. Bitcoin, for instance, has this built-in mechanism called the halving. It happens roughly every 4 years.
A halving, right?
The block reward I just mentioned gets cut in half. So miners suddenly earn 50% less new Bitcoin for the same work. This restricts the new supply entering the market. And historically, these halving events have often been followed by significant increases in Bitcoin's price and market cap, although usually followed by major corrections or downtrends later. It creates these cycles.
And just looking at the bigger picture, it's undeniable that crypto prices are just much more volatile than traditional assets like stocks or bonds. You mentioned that example from May 2022. In 1 week, Bitcoin drops 20%, Solana plunges 41%. Meanwhile, the Nasdaq Stock Index fell only 7.6%. That really highlights the risk level we're talking about.
Absolutely. And the entire market shows this. The total value of all cryptocurrencies hit $2 trillion in late 2021, then lost half that value in just the next 9 months. Huge swings. It's also incredibly dynamic. Think about this. Of the top 10 cryptocurrencies by market cap back in January 2018, only 4 were still in the top 10 by early 2022. Bitcoin, Ethereum, Cardano, Ripple, XRP.
Only 4. Wow.
Yeah, huge churn. Shows how quickly projects can rise and fall in this space. It's very unpredictable.
Yet, despite all that volatility and churn, we are seeing this clear convergence happening with traditional finance, aren't we?
We definitely are. Look at cryptocurrency ETFs, exchange-traded funds. These let investors get exposure to crypto prices without actually having to buy and hold the crypto themselves.
A bit like a gold ETF.
Exactly. After years of pushing back, the U.S. SEC finally approved the first Bitcoin futures ETF in October 2021. And then, a bigger step, the first spot crypto ETFs tracking the actual price of Bitcoin in January 2024. This really opened the door for more institutional money to flow in.
But there are caveats.
Oh, yes. It's worth noting these ETFs generally have higher fees than traditional ETFs. And a big point of concern for regulators, and should be for investors, is that the underlying crypto markets themselves still lack oversight compared to traditional stock exchanges.
That lack of oversight, it keeps coming up. But you can't ignore the big players getting involved. Major institutions, Morgan Stanley, BNY Mellon, payment platforms like Venmo, MasterCard, they've all started offering, or at least exploring crypto services.
Yeah, even JP Morgan Chase, whose CEO Jamie Dimon has been famously critical of Bitcoin, even they created their own private blockchain platform called Quorum.
Right. It really feels like the establishment, which was maybe hesitant or dismissive at first, is now very much engaging with it.
They are. And that increasing mainstream presence, that convergence, leads directly to the next huge topic: regulation. The rapid growth has, understandably, spurred governments all over the world to figure out how to handle this new asset class. It's a truly global challenge.
How are they approaching it internationally?
Well, internationally, you have bodies like the Financial Action Task Force, the FATF, They define crypto services as virtual asset service providers, or VASPs. And they recommend that these VASPs should be regulated, particularly for anti-money laundering, AML, and know your customer, KYC compliance, basically, verifying identities.
Trying to prevent illicit use.
Exactly. Then you have the EU, which has developed this comprehensive framework called Markets in Crypto Assets, or MiCA. That's been rolling out through 2024 and into 2025. It aims for harmonized rules across the bloc. And the IMF, the International Monetary Fund, is also pushing hard for a coordinated, consistent, and comprehensive approach globally. They recognize that a patchwork of different national rules won't really work for something borderless like crypto.
Okay, so international bodies are pushing for coordination, but this is where it gets really interesting because individual countries have taken such wildly different paths, haven't they?
Oh, absolutely. The contrast is stark. You have El Salvador, which took the radical step of making Bitcoin legal tender in 2021, a huge national experiment.
Bold move.
Then, at the complete opposite end, you have China. They ramped up restrictions over time and finally declared all cryptocurrency transactions illegal in September 2021, a total ban.
Wow. What about the U.S.?
The U.S. has been evolving, let's say that. You've seen executive orders touching on crypto from both the Biden and Trump administrations. The SEC, the securities regulator, has been very active, bringing enforcement actions against major crypto firms like Kraken for alleged violations. It's still very much a developing picture there.
And didn't you mention the Cook Islands doing something unusual?
Yeah, that was a fascinating proposal. They floated a bill that could potentially allow recovery agents to use various methods, possibly including hacking, to track down or recover crypto assets linked to crime. A very novel and potentially controversial approach.
Hacking sanctioned by law. That's something
Yeah.
else. It really shows the range of responses.
It absolutely does, and it highlights a major underlying concern: the potential misuse of crypto, the shadowy side. Because of its decentralized nature and the pseudonymity it can offer, crypto has unfortunately become attractive for illicit activities.
Like money laundering.
Exactly. Estimates suggest criminals laundered about $8.6 billion worth of cryptocurrency in 2021. That was up 30% from the year before. Often this happens through a small group of purpose-built centralized exchanges, platforms specifically designed to facilitate these kinds of illicit flows. Places like the darknet market Hydra or the mixing service Renbridge were identified as major conduits. And of course, the collapse of the FTX exchange and the subsequent conviction and 25-year prison sentence for its founder, Sam Bankman-Fried, in March 2024. That was a massive story. It really underscored the severe consequences when things go wrong involving fraud and financial misconduct at the highest levels of the industry. Anonymity doesn't always mean impunity.
No kidding. And besides the high-profile collapses, the history of crypto is just littered with major security breaches and outright scams, isn't it?
Sadly, yes. You look back at Mt. Gox, the big early exchange, losing nearly $500 million worth of Bitcoin back in 2014, then CoinCheck in Japan losing over $500 million in 2018. More recently, you had cases like Africrypt in South Africa or Mirror Trading International, where founders just vanished with billions of dollars in investor funds.
Then begins just gone.
Gone. A 2020 EU report estimated over $1 billion in crypto assets was stolen in 2019 alone through hacks and scams. The scale is just mind-boggling sometimes.
It really is.
And it's not just outright theft. There's another shady practice called wash trading.
Wash trading, what's that?
This is where a trader, or a group, simultaneously buys and sells the same asset to create misleading artificial activity in the market. It makes it look like there's more trading volume or demand than there really is.
Oh, okay. To inflate the price or just make it look popular?
Exactly. And studies have suggested this is rampant on unregulated crypto exchanges. Some estimates put wash trading as high as 80% of the volume on some platforms. There was a notable 2019 report by Bitwise Asset Management submitted to the SEC claiming that something like 95% of reported Bitcoin trading volume on the popular data site CoinMarketCap at the time was artificially generated through wash trading.
95%. That's incredible. It suggests the real market might be much smaller or less liquid than it appears.
Precisely. It means appearances can be very deceiving.
So given all this, the volatility, the scams, the wash trading, the illicit use, it's really no surprise that many prominent figures are deeply skeptical.
Yeah, not at all. You've had Nobel laureate economists like Paul Krugman pretty consistently calling Bitcoin a speculative bubble. Robert Shiller, another Nobel winner known for work on bubbles, has drawn parallels. Some have even called it a Ponzi scheme.
And Bill Gates had that famous quote.
Right. Bill Gates called cryptocurrencies 100% based on greater fool theory. The idea that you only make money if you can sell it to someone even more foolish, or rather more optimistic than you. Strong
They
words.
are, and this leads to a really critical question, especially for listeners. How can investors possibly navigate such a high-risk landscape safely?
That's $1 million question, maybe the $1 trillion question. Because unlike traditional financial products, stocks, bonds, savings accounts, crypto often lacks strong consumer protections.
Right, no FDIC insurance for your crypto wallet.
Exactly. If an exchange gets hacked or goes bankrupt, or you fall victim to a scam, your funds might just be gone. There's often little recourse. A study by the UK's financial regulator in 2021 found something quite worrying. Fewer than 1 in 10 potential crypto buyers were even aware of the official consumer warnings about the risks.
Only 1 in 10.
Yeah, and maybe even more concerning, 70% of them wrongly assumed cryptocurrencies were regulated and protected like traditional investments.
Wow, that's a huge perception gap.
It's massive. And this lack of protection, combined with the extreme volatility we discussed, it's not just a financial risk. There have been, tragically, reports of crypto-related suicides after major market crashes. It highlights the severe emotional and financial toll this can take.
That's awful.
And beyond individual investors, there are broader societal concerns, too. The anonymity features, while valued by some, can unfortunately make things like tax evasion easier or complicate law enforcement efforts against extremist groups who might use crypto for funding.
So, a really complex picture of risk. Okay, let's shift focus now and turn our deep dive specifically to India. It's a country that seems to be in a really interesting dynamic position regarding crypto, facing both huge potential and unique challenges.
It really is a fascinating case study. India actually ranks incredibly high in global cryptocurrency adoption, second globally,
Yeah.
according to some reports, just behind Vietnam. That points to a massive user base, a lot of grassroots
It's the
interest.
second in the world. That's significant.
Hugely significant, and the projections reflect that. The Indian crypto tech market is expected to reach around $241 million by 2030, growing steadily, and the potential job creation is estimated at nearly 877,000 jobs by that time.
877,000 jobs. Wow.
Yeah, in areas related to blockchain tech, crypto services, etc. Plus, investment has been flowing in. Indian blockchain and crypto startups had already attracted about $270 million by 2021, so there's real momentum in the ecosystem.
But India's official journey, the government's stance, it's been marked by this kind of dilemma, hasn't it? Bit back and forth.
Definitely a dilemma. You had periods of real hostility. Back in 2019, the Reserve Bank of India, the central bank, even circulated a draft bill suggesting that mining, trading, or even just holding crypto could be punishable, potentially with jail time.
That's incredibly strict.
Extremely strict. However, that proposed ban never became law, and crucially, the Supreme Court stepped in 2020. It overturned an earlier RBI directive that had effectively blocked banks from dealing with crypto businesses.
Okay, so the Supreme Court ruling was key.
It was. It essentially made crypto investments legitimate in the eyes of the law, or at least not illegal. But it didn't provide full regulatory clarity, which is still kind of evolving.
And then came the tax changes.
Right. In the 2022-23 budget, the government introduced a specific tax regime. Transferring any virtual digital asset, which includes crypto, is now subject to a flat 30% tax deduction on any gains. No deductions allowed against that income either.
30% flat tax.
Yes, and gifts of crypto assets are also taxed in the hands of the recipient. Now, this imposes tax liability, which acknowledges the existence and trading of these assets, but some argue it still doesn't explicitly declare crypto legal in a broader sense, it just taxes it. So that dilemma about its official status kind of persists. It's pragmatic taxation, perhaps, but not a full regulatory embrace yet.
Okay, so despite the regulatory uncertainty and the pretty hefty tax, proponents still see clear upsides for the Indian economy, right?
Oh, absolutely. The job creation potential is a big one, as we mentioned. India has this incredibly strong pool of IT and software development talent. The crypto and blockchain industry could really leverage that, creating potentially over 800,000 jobs by 2030 across banking, finance, IT, customer service. India could become a major global hub for this technology if the environment is right.
And what about benefits beyond jobs, like
Oh.
transparency?
That's another potential plus often cited. The inherent nature of blockchain, its immutability, the fact that records are very hard to change once confirmed, could theoretically bring down corruption significantly by making financial transactions much more traceable, at least on public blockchains.
Okay, traceability fighting corruption. Makes sense.
Plus, the transactions themselves. Crypto transactions, particularly using newer technologies, can be very time and cost effective compared to traditional cross border payments, for example. By cutting out intermediaries, they could potentially boost digital payments, especially maybe reaching underserved populations.
Right. And how does this tie into India's broader economic goals, like self-reliance?
Well, there's talk about how developing blockchain tech domestically, perhaps even an official homegrown digital currency, could support the government's Atmanirbhar Bharat initiative, the push for self-reliance. If this is coupled with clear, supportive regulations, it could attract significant foreign investment into India's tech sector and provide a huge boost to the fintech industry overall. It's about harnessing the innovation while managing the risks.
Okay, harnessing the innovation. But let's talk more about those risks, the downsides specifically for India. Where do the biggest concerns lie?
Well, the high volatility we've discussed is a major one. That, combined with the 30% flat tax and lack of deductions, can be a real setback for investors, especially smaller retail investors who might not fully grasp the risks they're taking.
Yeah, the potential for large losses is very real.
Very real. And the RBI, the central bank, remains quite cautious, even warning about potential destabilizing effects on the broader Indian banking system. Their fear is that people might shift significant savings out of traditional, safer assets into these highly speculative crypto assets, which could then burst, leading to widespread financial distress. They're worried about systemic risk.
So the financial authorities are clearly still very concerned.
Yes, and the consensus view, reflecting both government statements and expert opinions in the sources, is pretty clear. Regulation is required. It's needed to prevent serious problems, ensure cryptos aren't misused for crime, and crucially, to protect unsuspecting investors from excessive market volatility and potential scams. India is looking closely at the international guidelines from bodies like the IMF and FATF to help shape its own approach. Finding that balance is key.
And India, like many countries, is also exploring its own central bank digital currency, the CBDC, often called the digital rupee. How does that fit into the picture?
That's a really interesting dynamic. India has been actively piloting the digital rupee. The big question now is whether this official digital currency will exist in harmony with other cryptocurrencies, allowing both public and private forms to coexist and potentially reap the full benefits of the blockchain technology. Or will the CBDC essentially aim to replace private cryptocurrencies, bringing all the innovation under a centralized state-controlled system? It's a fundamental strategic choice India has to make, a fascinating fork in the road for its digital future.
It really is. Okay, so we've covered a huge amount of ground here. We've journeyed from, the cryptographic origins of digital currency all the way to its current status as this major global asset class, an asset class grappling with just immense opportunity, but also really significant risks, and this incredibly complex, evolving regulatory landscape worldwide. We've seen how it's impacting economies, countries like El Salvador fully embracing it, China banning it outright, and India navigating this really fascinating crossroads.
Yeah, and what's truly compelling when you look across all the sources is that fundamental tension, isn't it? The tension between decentralization, that core promise of crypto, and the growing, almost inevitable, global call for regulation and oversight. The materials clearly show that while crypto offers this transformative potential for efficiency, for transparency, for new kinds of innovation, it also brings these really substantial challenges related to financial stability, protecting consumers, and preventing illicit use. The industry is still maturing incredibly rapidly, and the rules of the game, well, they're still being written in real time all around the world.
Absolutely. So as you, our listener, process all this information we've unpacked today, maybe consider this. We have this incredibly rapid pace of innovation on one hand, and this equally rapid evolution of regulation on the other. How do you personally see that balance shaking out in the future? The balance between financial autonomy, that decentralized ideal, and the need for investor protection and stability. And maybe more personally, what role might you want to play in just understanding or even navigating this constantly changing, often unpredictable, but ultimately maybe revolutionary financial frontier? Something to think about.
अगर आपको वीडियो पसंद आया हो तो लाइक, शेयर और सब्सक्राइब जरूर करें।